It's 52% more expensive to buy than rent in the United States. This is the death of the American dream. Hello again, everybody. I am Dr. Richard Smith, aka the Doctor of Uncertainty, and this is Market Moves. So let's get right into it. And I always love to remind us about what I have been saying for a long time is the most important chart in finance. This is 10-year yields going back to 1787. Yes, the Constitutional Convention. We see a long-term 80-year cycle, really clean here over the last 100 years. And interest rates have come up off the mat, 10-year yields, and are rising. This is already a couple years old. Where are 10-year yields today? Above 5%. They hit 5% this week. That is just getting back to the average of about 4.8%. And we saw this, shoving of the beach ball down below the surface of the ocean. This thing's going higher than 5% before all is said and done. But we did hit 5% this week, probably pull back a bit. We'll see. But interest rates are going up. Yields are going up. This is a new environment for investors. We've been living with this declining rates environment for 40 years. We don't know what it means to invest in a rising rates environment. So that is the sea change that we're still in the midst of, is going to be playing out for decades and requires us to make some adjustments, right? So we've been talking about the yield curve inversion and recession the last few times. Whenever this yield curve stops inverting and starts to steepen, right? That's when the recessions hit. Here we are right now, steepening. We have a bear steepening, not a bull steepening. We talked about last week. Rates are still going up. They're just going up faster at the long end of the curve than they are at the short end of the curve. So we're still expecting a recession in the months to come. The S&P 500 has, we thought maybe this early October bottom was the October lows, but no, we're getting new lows right now. Still think markets are going to head up into the fourth quarter. But so far, we're still playing with the October bear. Volatility down here is not soaring, but not retreating either. So still working through the October pains. On the short term, I still think it's a buying opportunity. I'm starting to nibble. Longer term, we still got some issues. The big thing I want to talk about this week is what I'm calling the death of the American dream. Now, maybe it's not the permanent death. Maybe it's just the death for a generation. But look, we got problems. Interest rates and yields are rising. Again, they're 5% now. They were 1% not too long ago. 5% might not sound like that high, but it's very high from what we're used to. So this is a big adjustment that we're all having to make. And the yield curve is steepening. Meanwhile, mortgage rates are also on the rise. 30-year fixed mortgage rates are now nearing 8%. This chart goes back to 2000, so that's the highs for this century. Again, totally unfamiliar territory for the vast majority of Americans. This is home inventory, homes that are for sale, okay? Again, at century lows, 21st century lows. There just aren't enough houses to buy. People aren't selling their homes because they have mortgages on them that they don't want to get out of, right? With low interest rates, because if they go into a new mortgage in a new home, they're going to be paying a lot more in interest. So people are staying put, and it's hard to find homes to buy on the market. Meanwhile, the median income annual income that a household needs to be able to afford a house is now $115,000. But the median income in the United States is only about $75,000. So again, buying a home, the American dream, is out of reach for most people and more people right now. Final chart on this point. This is showing us the ratio of the cost of buying versus the cost of renting. Okay, so when it's going up, it means the cost of buying is going up. We're now at, as far back as this data goes, 1996. It's 52% more expensive to buy than rent in the United States. Most people are renting, and if you're in the rental business, this is good for you. It's not good for the middle class. Buying homes, buying property has been the surest way the middle class has prospered in the United States. And again, all these themes that we've been looking at about crisis, whether it's fourth turning or big debt cycles or Peter Turchin's fight amongst the elites in end times, degrading of the quality of life for the majority of Americans, that is still in play right now. We're in the midst of it. There's going to be ups and downs, but all of this data around housing and the American dream only reinforces that this is really going on. We got mortgage rates above 8%, inventory at multi-decade lows, median required income to buy a home is at all-time highs, but household income is not kept up. And so much harder to buy than to rent today. Meanwhile, inflation continues to, maybe it's slowing down a bit, but look, orange juice, sugar, and cocoa are the biggest year-to-date performers across all of the futures markets. The cost of breakfast is going up. Basic breakfast, orange juice, sugar. So what can I say? This is where we are. Here's the CPI over the past, going back to 1970. I still think that we are in the early phase of the 1970s here. Okay. We've had the rise. We're coming back down. Yeah, we may overshoot here, but I think we've got at least another leg up. And I wouldn't be surprised to see this same three peak shape before all is said and done, with, again, us adjusting to a sea change, a cyclic sea change of rising rates. Why do we have to go through this turmoil? Because we just don't get it yet, right? We're not expecting it, and we don't know how to manage it. We're still managing from 10 years ago. So that's where we're at. Inflation continues on, food commodities leading the charge, CPI coming down, but not fast enough, and likely will rise again before all is said and done. So moving on now, let's talk a little bit about kind of a macro view of the market. Yes, we've got rising rates, but what's going on with the market as a whole? This is a new model that we built since we last got together, and I'm pretty excited about it. I'm calling it the S&P 500 recession model. And the idea here is to tell us, again, using this yield curve inversion, the 10-year minus the 3-month, okay? When the curve inverts, we see it, this little red section down here, okay? And we wait until the curve stops inverting for about 100 days, okay? So it's not right away, but we wait until the curve stops inverting for about 100 days. And then we want confirmation that the S&P 500 is below its 200-day moving average. So if the yield curve inverts, stops inverting, and the S&P is below its 200-day moving average, then we are in defense mode. And that's what we've got here, okay? All the way down. Same thing here. Yield curve inverts. Uninverts for 100 days. S&P is below the 200-day moving average. Down, 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 down. Now here we are. The yield curve inverted here, but the S&P wasn't below its 200-day moving average. And it's inverted now, and it has not fully uninverted. It started to steepen, but it hasn't fully uninverted, and the S&P isn't below its 200-day moving average. So I still think that the major pain of a recession and a stock market correction are a few months down the road, maybe even 6 months down the road. But I think we're starting to see the yield curve steepen, and we're not seeing the S&P make new highs. So cautious time, but not in, red alert mode yet. Meanwhile, we are heading into the most bullish time of the year. We've talked about this over and over again. October hasn't panned out with positive returns yet, but we still got November and December, which are two of the strongest months of the year. So still expecting some fourth quarter strength. One more thing here, we talked about this last time. This is just a model of kind of peak, slowdown, recession, trough, recovery, expansion, and which sectors do well during these different times. So during recessions, right, you want to be in consumer staples, utilities, healthcare, energy, right here. I think we're in the slowdown phase right now. If we go to the slowdown, best performing sectors, technology, industrials, financials, right? Again, slowdown, heading into recession, probably bottoming sometime next year, into recovery and expansion. So this is a model that I'm keeping in mind because I'm expecting recession. And if we just look at year to date, which sectors have done the best, we have communication services, which I'm pretty sure, not sure why, includes Amazon. But technology basically is dominating consumer discretionary, energy. And if we go back, we see in expansion periods, technology, consumer discretionary, energy, right? Moving into a slowdown and then ultimately moving into recession. So I think it's time to be pivoting towards consumer staples, utilities, healthcare, energy, and definitely away from technology, financials, etc. That's informing my portfolio construction and management thinking and decision making. Okay, so let's talk about portfolio construction again, because I think it's very important, and I know it's important to you. So over the past couple of weeks, some things have popped up on my radar. There was a good article in the Wall Street Journal about what are great investors with long-term record-breaking track records. What are they doing in this 5% yield world? So a few ideas that came up. GATX Corp from Mario Gabelli of Gamco. I think he might be one of the most successful asset managers of all time. Rail car leasing. That works for me with the theme of rebuilding the real world. Lind PLC, held by Sarah Malik from Nuveen, industrial gases and engineering. Procter and Gamble held by Steve Eisman at Neuberger Berman. Consumer staples fits the business cycle thesis about where we're at in the business cycle. Vanguard small cap value was one that caught my eye. Vulcan Materials, speaking of rebuilding the real world, they're in the business of rocks, right? So definitely fit that category. Also owned by Steve Eisman of Neuberger Berman. Did recently get slammed on an earnings and revenue beat, but I still think it looks interesting here. And Southern Company, which has consistently been the best run utility. So here's 6 ideas, right? GATX, LIN, PG, VBR, VMC, and SO. How do we decide if one of these is a good fit for our portfolio? Let's jump over now to Finiac. This is the portfolio that we made some adjustments to last time. It's currently got Abbott, Bristol Myers, Bitcoin, commodities, some fuel, Dino, energy exploration, EOG, FICO. Yes, financial, probably start to move out of that eventually. India, Coca-Cola, Southwest, Newmont, Otis, they make elevators, PAL, Palladium, AT&T for infrastructure, and finally TLT to get some of these higher yields. And, as yields probably correct, come down a bit over the next 6 months or so to get some benefit out of that. So long bonds, taking advantage of the dramatic correction that we've had in bonds and getting some of the bounce, maybe a dead cat bounce, but still expecting a bounce in our portfolio. So let's take a look at whether or not some of these 6 new ideas might fit well with our portfolio. So I just made a collection here that I called Top 6. How did I do it? I just went here to import assets, typed in the tickers, GATX, LIN, PG, etc. So they're already in here. Heading back to our portfolio, our 23Q3 adjustments. And I'm really focused on these 2 metrics right here, diversification score and exposure. Very happy with the diversification score on this portfolio, 63.3%. That's not Ray Dalio 80% level, but 63% is an excellent diversification score. I like to see it above 50. So 63% is something that is great. Exposure, $451. This is on a $10,000 hypothetical portfolio, but that tells me, if things go against me 10 days in a row by 1 standard deviation, I'll be down about $450 on every $10,000. So just sets expectations, right? And expectations are so important because it's when things happen outside of our expectations that really we become reactionary and end up making decisions that eventually we regret. Let me look at one other thing here. Just highlight this. Zoom in a little bit. Oops. I know there's a lot of numbers here, but what I want you to see is the black, right? Bright green is perfectly correlated, 100% correlated, right? These things are all correlated to themselves. Coca-Cola is 100% correlated to itself. Commodities are 100% correlated to itself. So what we want to see in here is black. And look at Bitcoin, for example. It's pretty dark on this row, uncorrelated, just slightly negatively correlated to almost everything in this portfolio. That's fascinating. Palladium, also kind of minimally correlated. Newmont, not that correlated. TLT, not that correlated. So the fact that this whole covariance matrix, sorry for the multiple syllables, but the fact that this has a lot of dark in it and not a lot of bright is why we have such a diversified portfolio. So let me jump back over here and let's see if any of these new stocks, that's what I meant to do. I'm going to go to the workshop. From our new top 6 collection, might be a good fit for our portfolio. So here we go. We got the top 6. I like to sort them by correlation. There's only 6, so maybe I'll just sort them by ticker for now. And just go down the list. GATX, rail car leasing. hasn't grown a lot over the past year, has kind of a little bit higher, relatively normal volatility. What happens if I add GATX to the portfolio? Brings down the diversification by about 1%, not terrible, and increases my exposure by about $12.64. I prefer to see that go in the other direction, diversification up, exposure down, but not terrible. LIN, industrial gases, also bringing the diversification down a bit, increasing the exposure a bit more. Procter & Gamble, consumer staples, right? Going into a slowdown and a correction, increases my diversification and actually reduces my exposure. I like it. Southern, the utility company, Southern Company, again, decreases my diversification, increases my exposure. VBR, small cap value. I like small cap. I like value. But again, decreases my diversification, increases my exposure, not by as much. And finally, Vulcan Minerals, decreases my diversification, not by as much, but increases my exposure. Not surprising because it's the most volatile stock in the collection. So out of all these 6, the one that looks most interesting to me is Procter & Gamble. These are all owned by very successful investors. I'm not too worried about their fundamentals. There's a lot of conviction in all of these stocks. I'm letting the great investors of the world do my due diligence for me. And I'm looking for what gives me the most diversification and what works with my macro thesis, which is that we're heading into a slowdown, then into a recession. We're in the middle of the 4th turning. And ultimately coming out of that, we're going to be rebuilding the real world. So Procter & Gamble looks like a good add to this portfolio. Let me check it and save my changes. Yes. Now we got a new portfolio, just like that. Diversification, 64.6. Doesn't get much better than that. All right, so that's it for today. Keep in mind, rates are rising, going to be for a long time. It's a sea change environment. We're heading into the seasonally most bullish period of the year, okay? We think a recession's coming, doesn't mean we can't have some gains over the next couple of months. Tends to happen. Hasn't happened yet, but not out of the question. We're building a defensive portfolio, even though we're not fully in defense mode yet. We don't have the S&P below its 200-day moving average. We don't have the yield curve uninverted for a long enough period of time yet. Whatever the environment, though, we want to have great portfolios, well diversified, and with an exposure that works for us. That's what we've done in these tools, and I think we're putting together a pretty killer portfolio here. And I hope you've enjoyed this. Hope you've learned something today, and I look forward to seeing you again next time on Market Moves.